And it said that there are two big risks that, that could threaten our retirement corpus. One, of course, is market volatility. And the other, interestingly, is what they call longevity risk. So does it mean, say, if I were to live to 95 or 100, I could run out of money?
Yeah, pretty much, right? You would run out of money, or look at the other way around, you would have to compromise a lot more. Number one priority is retirement, because you can fund everything else, but you can't get a loan for retirement.
90 or 100 is not something people typically thought of in terms of financial planning. So if, say, I were to live another decade, decade more than planned for,
correct,
how much money would I need? I mean,
so when you take a very, very ballpark, if, let's say, take a rule of thumb, if you want to live another 10 years or say 15 years, you're going to easily need about 30 to 40% more capital accumulation by the time, say, you retire. So let's say retirement, let's psychologically put it at a milestone of, say, 60. So after that, if you want to live off your money, and if you were planning till 85, now if you want to increase that to, say, 95 or 100, you easily need 30-40% more.
So did you know that money could literally buy you good health? So research has found that stress from money troubles as one grows older impacts health the most. And this is even more than stress from, say, disease and disability, or the grief from divorce and death. The reason is simple. Not having enough money as you age leads to stress. And in a 2024 study, British scientists found that stress from only financial strain increased the odds of individuals landing in a high-risk health group by almost 59%. Now, they had compared this to stress from, say, disease, from disability, from divorce, from death, and even caregiving. So that's how important it is to ensure that you have enough money as you grow older. Now, here's why this becomes even more important for you and me. So especially if you're in your 30s and 40s, I'm sure that by now you have heard that you can expect to live longer than previous generations. The big question is, will your investments last as long? Have you planned for that 100-year life? And how does one even do that? So that's the question we are asking on the Longevity Shot today. Hello and welcome. I'm Kavita Krishnan. And of course, you are watching the podcast that gives you the resources you need to prepare for the 100-year life in India. So this is brought to you by the Never Too Late channel. And if you haven't subscribed to our channel yet, make sure you do so now. So joining me is Karthik Jhaveri. He's the Director of Investments at Transcend Capital. Karthik, welcome.
Thank you.
So a bit about Karthik. He is among India's top financial planners. You've probably seen him on television or caught one of his courses or webinars online. His day job is literally managing money and making your money grow for you. So Karthik today joins us to discuss how to get our retirement funds longevity ready. So Karthik, I would like to start by this. I came across a very interesting report from Morgan Stanley while I was prepping for this. And it said that there are two big risks that, that could threaten our retirement corpus. One, of course, is market volatility. And the other, interestingly, is what they call longevity risk. So does it mean, say, if I were to live to 95 or 100, I could run out of money? Is that what it means?
Yeah, pretty much, right? You would run out of money, or look at the other way around, you would have to compromise a lot more. Because, see, all along we've been taught, and all institutions have this as a KYC or as a compliance guideline, if you like, which is they ask you the risk profile. Then we have products also which tell you that this is going to move according to life cycle. So basically, all along, everybody has taught everyone that as you age, you must reduce the percentage of money that you have in equity. What that obviously means in simpler words is that your money will grow at a slower pace, and you will have more and more money into fixed income kind of products or a basket of products. So the speed reduces. If the speed for the growth of your money goes down and inflation is continuously moving up just because you've retired or you are in that phase of your 60s or 70s or 80s, inflation is not going to stop. Interest rates, the world across, are only going to move downwards. Even if you look at India, 20 years ago, perhaps the interest rate was double of where we are today. So today we are at around 6-7%. We've seen times of 14-15%. People were happy in those days because they knew that they could just put their money with ABC institutions and they would get there 14% happily. But now that part of the time has gone, so you're not going to get those returns. So yes, there is a very, very big risk that money will get over. It will not move at the pace you want. It will not give you the kind of cash flow that you need, because cash flow is an increasing activity. You are going to need, if say you need 100 rupees today, you're going to need 106 or 108 next year, and so on and so forth. So yes, there is a very well defined risk. And like you mentioned a while ago, 59% was the amount of stress increase, right? That's true, because financial insecurity is something that will actually trigger all sorts of first mental problems and illnesses, and then cardiovascular, and then diabetes. I mean, it just goes on, it's like a cascading effect of problems.
And of course, to treat all of that, you need even more money. So it's like this vicious circle that we are setting up for ourselves. So, I mean, you can prepare for longevity all you want. If you don't have your money in place, it's going to be a problem. That's what you're telling us.
Indeed.
So also, taking up from what you just said, you named a lot of factors, inflation, interest rate risk, and we will, talk about all of those.
Indeed, yes.
But just to get a sense, now, I mean, a lot of us have been planning for retirement. So how is it different now? I mean, with the prospect of the 100-year life coming up, are you telling us that, whatever money we've set aside or whatever corpus we've been building won't be enough? Was it made with a certain other age in mind?
No, I wouldn't say it's made with another age in mind. But what happens is people generally like safety, security, comfort. I mean, all those adjectives, if you like. So even when you are young, we've seen for the last so many years, people like to invest into a PPF. People like to invest in schemes like Sukanya Samruddhi. People are still buying a lot of insurance, which is the savings-oriented insurance, where they typically make about 5, 6, 7%. If you have a policy which is, for example, running for the last 20 years, you probably make about 8% on that. So people like that comfort. So they gravitate towards that comfort when they are young. Now, that is the time, if you shifted gears, then you will have so much more by the time you are 50s and 60s. Because you see, you've earned your money, and there is a huge fear factor playing that you don't want to lose this money. So therefore, you go and put it in safe things. And ironically, what you should do is the opposite. You should actually put the money into a place where it's going to work the maximum for you, grow the fastest for you. And then when you are at 50 and 60, you can actually do some serious calculations to figure that if you are going to now live till maybe 80 or 90 or even 100, like you say, will you have enough?
Right. Another thing, so I've often heard that, most typically plans are made for people, so that they have enough money till their 80s or 80 till they're 85 or something. 90 or 100 is not something people typically thought of in terms of financial planning. So if, say, I were to live another decade, a decade more than planned for,
correct,
how much money would I need? I mean,
so when you take a very, very ballpark, if let's say, if you take a rule of thumb, if you want to live another 10 years or say 15 years, you're going to easily need about 30 to 40% more capital accumulation by the time, say, you retire. So let's say retirement, let's psychologically put it at a milestone of, say, 60. So after that, if you want to live off your money, and if you were planning till 85, now if you want to increase that to say 95 or 100, you'll easily need 30-40% more. Because the speed at which inflation will catch up is going to be enormous. What that also means is that if you have to accumulate or have a larger sum by the time you're 60, your deployment right now, your investment right now will also shoot up by about 30%. Very, very simply put. I can share some numbers with you as we move along. But I mean, we can give some examples so people can kind of make some notes of it if they like. But yeah, it's going to be at least 30 to 40%. I mean, that would be a fair number to work with, both ways. Capital also, and your investment deployment now. As well. Deployment also.
Right. In fact, Karthik, while I was preparing for this, I also asked the readers of Never Too Late if there were some questions that they had. And very interestingly, this is a term I've heard you use a lot. One particular reader wrote back saying that, we should, that he uses a 6-jar system. The reason I brought up what he said is also very interestingly, now the 6-jar system, of course, is goal setting. So
Yes.
if you are planning for the 100-year life, uh, how do you then set your goals, or how do you plan your money? What are the goals then you start allocating for?
So, according to the formula of financial planning, you would always look at two basics first, which is just make sure you have enough life insurance, enough health insurance, right? And basically, there is contingency sort of a plan that, God forbid, what if something happened to you? And that's a very small cost for that. So, you just get that out of the way. We normally suggest that then retirement should be number one priority after that. So, if you are going to set on your journey, the first thing, get your health insurance, get your life insurance out of the way. So, you're secured in that sense, right? Because you're going to take loans as you move along, and health insurance premiums is necessary. Even if you're working in a company, what if you're in between jobs? You need all of that. So we know that's
So what's a good rule of thumb to use? How much should the value be in relation to your income? Say life insurance and health insurance.
oh, life insurance is pretty simple, pretty straightforward. Basically, whatever you are earning, let's say that has to get replaced. So take a rule of thumb of even 20 times your annual income. That's good enough. That's not a problem.
Okay.
Plus all the liabilities that you have, plus all the future liabilities that you might take. So let's say my income is, just for an example, 10 lakhs. You take 20 times that, that's 2 crores. And then let's say over the next 5 years or 10 years, I intend to buy a house, a property, which I'm going to borrow money, another 2 crores for that. So then 2 plus 2, 4 crores on that. And then you have financial goals if you've got kids and things like that. So then depending on what you want to do for the kids, even if you take another additional 2 or 3 or 4 crores, that's good enough. It's going to cost, of course, but when you're younger, the cost is so much more cheaper. And as you move along age, you start removing that insurance. So you also start discounting, you also start porting your policies, moving to other companies, or you completely discontinue that contract, take another contract. I mean, that kind of things. Health insurance, I think, is very, very straightforward because these days you would take at least a 50 lakh cover if you're living in a larger city, float a cover, and the cost is not prohibitive in that sense. Life insurance, you might find that a little pokey in terms of the cost. But then yeah, number one priority is retirement because you can fund everything else, but you can't get a loan for retirement.
Right. You can't get a loan for retirement, and that is exactly what we are looking at over here. So
Exactly.
when we are looking at retirement per se, what you did mention health, finishing off your health insurance and life insurance. But apart from that, what are the things that we need to save for? What are the jars if we were to use the
So
reader's
let's
example?
say we have one simple jar, which is contingency, in that you put your life insurance, health insurance, and some 6 month money. That's a small little thing. The next most important jar, to my mind, would be retirement because, like I said, you can get a loan for everything else. You have kids; they want to fund their education nationally, internationally. You still get loans for that one way or the other. So first jar is retirement. You start saving the fastest. The earlier, the faster you save, the better it is because then it's going to grow that much, it's going to compound that much, right? So your second jar is retirement. Your third obvious thing is going to be education, which is what you want to get for your kids. Then the fourth could be travel and luxuries that you want to do. Now that's a very important thing because I mean, we live in such fast-paced lives and, like a fast food kind of a life and a fast-paced life, and everything's happening instantly. So you need your, detox days. You need your days to, relax. So it's important that you have this budget because it's very expensive these days even to travel anywhere. So then the next job would be travel. Okay. And then the next job would be for dependence because you see, we are thinking of all of this, but the previous generation always thought that I have my kids, they will take care of me the way I took care of my parents. But it's kind of a little different now. Plus, you might be in another city, you might be in another country. So you need to have reserves because your parents today, if they are 60, if they're 70s or 80s, are not going to get additional insurance. It's going to be prohibitively expensive and all of that. So you're going to need a little reserve for that. So you need to create a little dependence fund, if you like, right? And then your last jar could be then, the luxuries that you want to indulge in, maybe buy a new car or do interiors for a house and, all those things. So that would be much lower in the priority. But yes, your number one priority and the biggest share of your wallet, if you like, is going to go towards your retirement. And
Right. Now, you spoke about health insurance. Now, of course, we've also seen that health insurance doesn't necessarily cover everything.
yes,
And as you grow older, as you know, you, I mean, God forbid, but say you already have some kind of a health condition, then chances are of getting insurance for the other, complaints are very low because then it gets into that entire
or it would be excluded.
Excluded, exactly. So in that case, how do you fund your health needs? Because you're also looking at diagnostics, you're looking at drugs, you know.
You're looking at insulin injections, you're looking at all the support systems which tend to accumulate to a lot of money. You're also looking at nurse support, you're also looking at help, 24-hour help and that kind of things, and it all adds up to quite a bill. So that's your dependence fund or health fund, if you like, the one of the jars that we spoke about, the fourth jar, if you like. So in that jar, you are on one side preparing for your retirement, but on the other side, you are providing for your dependent parents and whoever else is dependent in your house. But that same fund is also going to come and help you. So over a period of time, the label would change. It would not be dependence fund, but it would be your own health contingency or health support fund, if you like. So that's another jar which needs to have allocation. But we are not in a tearing hurry for that, because your resources to begin with are quite limited. So what happens is, the more you deploy towards the retirement goal, you might find that you're typically about 50 or 60 and you have a few crores behind you. Then that's very nice, a kind of feeling. But fortunately, unfortunately, the way things happen is most people start their journey only when they are about 40, because that's the time responsibilities are really hitting, expenses start actually pricking your budget and things like that. That's the time you think about, oh, let me start planning. But if you actually started when you were 25 or 30 from your very first salary or very first income, then you would be in a much better position.
Now, Karthik, you also brought up another thing which is, always been on the back of my head also, which is that we are probably one of the first generations in India where, we are not going to have the support of the younger generation, or we do not want to have the support of the younger generation. We would rather be independent.
Sure.
But that independence, of course, would come at a cost. I mean, we'll have to figure out how and where we are going to live. Living where we are currently may not be the best thing to do, right? So
Sure.
do we need to plan for that as well?
I'm so glad you mentioned that. Yes, because what happens is, when you're living in a larger city, right, it's not only just the cost factor. There are other factors also, like the climate, the environment, the pollution, and all of that. So if you're living in a large city, it's all going to add up. Like today, if you take a tier 2 city or a tier 3 city and compare the cost of living, you'd be amazed at the difference that there is versus a metro city or a financial capital like Mumbai or Delhi or a Bangalore or something like that. So if you go into the hinterland, yes, it would be so much cheaper. Then you don't have to worry about things like reverse mortgage. You don't have to worry about all those kind of, how do I
But then
fund?
you do have to worry about a mortgage, because how are you going to get a home loan to, say,
Yes.
buy property or buy a flat or whatever it is that you want to buy in this small tier 2 city
Yeah.
after retirement?
Yes. Yeah, but then you don't do it that time. You start planning for it while you are in the go of, earning. But at the same time, if you want to have, let's say, a 4-bedroom house in a place like a Mumbai, it might cost you, somewhere central Mumbai, might cost you about 5, 6, 7 crores, depending on which area you're looking at. But within about 2 crores, if you go to a tier 2 or tier 3, you might actually have a house there, an independent house, double the area, and you can start building it while you are earning. So it's not going to cost you so much, but get your first house up there, because you need a house, you need your necessity. Or if you're living on rent, then you can start investing there. So this kind of dialogue and discussion with your planner and whoever is doing things, because you've got to achieve everything out of what you have. You can't suddenly increase your income double or triple because your need has now, or you've been sensitized of the fact that you need all this funding for all your various goals. So we need to start moving along, start planning it now, start having these conversations, and things will then become quite comfortable as you move along life.
But also, coming back to another thing that you said earlier, you spoke of inflation from both rising prices and from currency depreciation.
Yes.
Especially, if you're looking at traveling, and a lot of us want to travel in our retirement. So how do we sort of prepare for that?
So I like to suggest to have a travel fund. What happens is, normally travel is looked as something like, let me see at the end of the year, if I've got a little bit of money left, perhaps I can do that. why should it be that you want to go to Europe and it's like a lifelong kind of a dream that, I want to go and see Eiffel Tower once? So our thinking and our mindset itself needs to change. So once you sort of build up something, now I'll give you a beautiful example. A few years back in one of the events that I attended, there was a speaker and who was talking about the fact that he's made a 75 lakh fund. And he's saying from 75 lakhs for one person, you can pretty much travel the whole world. But that was, say, a few years back. Maybe today it's probably 1 crore and 25, for a person. So the idea is, if you actually created a fund like this, very simply put, say 1 crore as a fund. Now, 1 crore as a fund, and if you're earning, say, 10% on that fund, you're making 10 lakhs a year. Very simply put. So with that 10 lakhs, can you have probably 1 or 2 holidays, depending on the country you choose or the locality that you choose or the geography you choose? You could do something nationally, you could do something internationally, but you have the option of choosing to go out every few months. It could be for a 3-4 day thing, it could be for a 10-day thing. But if you have that resource, then you have the options. So again, it's an individual thing. But if you're somebody who likes to do that, then yeah, pretty good idea to start having that kind of a thing, and you can pretty much have holidays for free for the rest of your life.
Now that's a very nice, very lovely prospect to think of. But on that note, you've been talking all this while of getting our funds in place, a fund for health, a fund for travel, a
Yes.
fund for living arrangements, if you will. But the big question, of course, where do you invest? Because now we are also talking super long term. We are no longer just talking
Yes.
85 years. We are looking at a 100-year horizon.
Yes.
So where do we put our money?
So think about it this way. If you had to travel from, let's say, point A to B, which is 50 kilometers away, you need the fastest mode of transport to get there if you have little time or limited time on your hand. The same for investment. So on a risk profiling note, if you were to choose that I want to take a balanced risk, then we have to come back and say, then listen, your goals will not get fulfilled. You will not have all of that. You will not have so many things that we are planning to do in life, right? So I just answered your question around about.
I get how you answer my question. So I'm going to put a bunch of other questions to you.
So the answer is, you need to be fast on your money, and you need to be in a position to generate so much more, and you'll have to overlook the risk management and your age profile.
Yeah. So let's look at it from an age perspective. Say you are in your 30s, you have time. If you're in your 30s, what are the asset classes that you should be looking at?
Now, that changes from time to time with the advice of a planner. But broadly speaking, if you are wanting to do it yourself, 100% equity.
Okay. And 100% equity, you keep your money in equity for how long? You
keep it perpetually there. So what happens is, you start deploying, you keep the money there. Okay. Now you have professionals managing. That's the reason you have professionals doing it. So what the professional will do is, he will at the right time, move your money from, let's say, equity to, he will, sell some part of the security. Let's say if we're talking of a mutual fund, make it very simple. So if you've invested 100 rupees into a fund, let the fund manager decide that he wants to invest 80 now or 90 now. He wants to hold some cash. And then, at the time is right, and when the professionals feel that this is a good time to deploy, he will change it. So you've got a lot of options like that. But broadly speaking, you need to be into equity. Now, once we say equity, there are so many subclasses and sub-buckets in that, right? So when you say equity, now here comes professional advice. So somebody would say, okay, put 30% of your money into blue chips and large caps, which will kind of perpetually keep growing. But on the other side, maybe you want to put another 30% of your money into sectors that are likely to do very well in the next 3 years. Say, I'm just giving a random example, say infrastructure, say banking, say financials. So then you want to have a little more allocation, or a very pre-planned allocation to that. And then the professional could come back to you in about 3 years' time and tell you, okay, now I think pharma has done its job, and probably you need to go into chemicals, for example. So that's where that little kind of help comes in. But broadly speaking, 100% equity, even if you follow a very simple rule of thumb, 30% large caps, okay, which is blue chips, or 20 and 20 into mid and small, that makes it 70% in total. And then have this 30% into these different assets. Now, that 30%, by the way, could also have things like commodities like gold and silver, which are doing exceptionally well. They've done well, and a professional probably knows, and perhaps a lot of people also individually do a lot of readings. So we're reading a lot of things that are happening, not just from the point of view of hoarding or the point of view of industrial use of gold and silver. But there is actually a lot of action going on. A lot of central banks around the world are buying. So there is a reason why they are doing that. Maybe we want to participate into that rally for the next maybe 2 or 3 or 4 years. But yeah, basically, I think it's a good idea to invest in professional health also. So.
Right. And that is very important because the advice that you're getting here is very, very generic advice. So while you can use the broad contours of, you can use the advice to, make the broad contours of your financial plan, go to a professional to actually allocate when you sit down.
And go to 3 people. I mean, go to 3 or 4 of people, so that you learn as well. You get a little more educated, you get a little more informed, and you can hear 3 or 4 different perspectives. I'm pretty sure that you'll hear similar. I mean, the fabric of that conversation would be reasonably similar, but you might get some interesting ideas. And of course, you want to divide your eggs into different baskets, right? So you may want to work with 2 or 3 people also. That's not a bad idea either.
Right. What about for people in their 40s?
So I don't think it changes too much, honestly, because see, we are talking from a point of view of 80 and 90, right? So even at 40, even at 50.
Karthik, we're talking 100. Let's
exactly.
Set the bar there. We're talking 100.
Exactly. So when you're 30 years old or 40 years old or 50 years old, see, if you're 50, for example, or if you're mid-40s, and if you don't have enough, then you need to have very, very aggressive strategies. Then see, when I'm saying equity means there are levels in equity also, for example. Maybe at some point, if you're in the 40s and 50s, you want to have a PMS because you also have a substantial amount of funds at that point of time. So you want to get into a PMS, you want to get into an AIF, you want to get into a small cap PMS. So when you explore the area of PMS, there also you have blue chips and you have levels there. So in equity, you have a plain vanilla flexi cap fund right at the bottom, and then it kind of moves up in complexity and in terms of variety. So if you move higher, you have lesser, then you need to move faster. If you are reasonably okay, then you can keep maintaining this allocation. See, broadly, you will do very well. But I'm thinking even at 60, you will need to have a substantial chunk of your money in, and which is why I said that risk profiling. You don't want to choose. You cannot afford to choose that I want to take low risk. Because low risk means, and with the way the advice is becoming very robotic these days. So what happens if the moment you say low risk means you'll have only 20% money in equity. So what will happen when you touch 80? You won't have enough. And, money will start rapidly dwindling itself. So that kind of a thing. So I would think even at 60, you need a substantial chunk in equity. Sorry, I just jumped from 40 to 50 and 60. But because we are talking 100, right? Because it's still so many business cycles. And every cycle is about 5-8 years. So you will see a rally, you will see a trough, you will see a rally and a trough.
So that's another thing. And also, just a clarification here, when you say equity, you're not saying, you don't mean direct equity, right?
Like I said, there are buckets and categories, right? So first, maybe you want to, if you have little money, for example, today we have so many options and there's such beautiful products. If you just have 5 lakhs, let's say, and if you want to not do a mutual fund, of course, that's the most logical thing to do. Okay, below mutual fund, there is ETF as a category also, exchange traded funds, okay, which are even more passively managed. So you've got ETFs, then you've got mutual funds, then you've got direct equity. But you can do direct equity with as low as 5 lakhs. There's a category called small case, beautiful area to explore. So you can even do that a little bit simultaneously. But otherwise, ETFs, mutual fund, then you have direct equity. Now, within direct equity, then you have these PMSs, and the PMS will do different things for you. Then above that, you have an AIF, which will again do different things for you. You have international equity, that will also do a lot of different things for you. So you have quite a variety of things even within the equity space. But to answer your question, yes, direct equity is also very, very important because the level of aggression sometimes is much more in direct equity. While in a mutual fund, you can postpone your tax forever, in the sense, let it grow, let it grow, let it grow. The equity may not give you that kind of a tax facility, but taxes are anyways rising year after year and every few years. So, I mean, if you don't pay today, you'll have to pay something 10 years down the line. So it doesn't matter. To my mind, I'm tax neutral, but these strategies have the capability of producing much more for you, right?
What about index funds? Now, this is a category that, if I'm not mistaken, Warren Buffett also asked people to put their money in, right?
Yes, because if you don't know anything, just put in an index fund, or see, you have an option. Index fund and ETF is not very different if you look at it in that way. So if you, very simply put, if you have a demat account, you have the facility to buy an ETF, an exchange traded fund, right? If you were to go into an index fund, then you're giving it to a fund manager who would indirectly either replicate the index for you or he would buy the ETF. So if you are somebody who wants to invest in index, a better thing to do, a better suggestion to do is to open up a demat account and pick up that ETF yourself. Then don't sell it for the next 20 years.
So if you are listening to this and if you're living in India and if you're in 30s, 40s or 50s, then equity is something that you should be looking at. It should be where most of your portfolio is allocated to. But what are the other assets that we can look at? Because also, Karthik, as we grow older,
Yes.
Probably after the 60s, we would want to slow down. I won't say retire, because if you're looking at a 100-year horizon, you're probably going to be working in some fashion till your 80s. But you would want to slow down. You would not want to be tied to a 9-to-5 job. In that case, you also want a secondary income stream,
Yes.
money that comes to you, to your account on a monthly basis.
Yes.
How can you plan for that?
So now there are two very interesting options. One is the easier and simple option, but it gives you very low rate of interest and charges you the highest tax as the situation stands today. And the other is a much more sophisticated manner of getting that income flow. And the taxes are very, very controlled or nominal in that. So let's talk about the first one, the easier and the comfortable, which is to buy retirement products. And retirement products are like nothing but pension products and things like that, which are brought to you by a host of insurance companies, right? Now, what a lot of these products do is they make you invest for some time, or if you're already at a senior age, they'll give you an option of making a single investment, and then they'll start paying you a certain percentage for the rest of your life. So, for example, you could invest 100 rupees, and then they'll say, okay, let's say 1 lakh of rupees, just to make it easier, and they might pay you 7% through and through. That 7% is not going to move up. It's not going to be in line with inflation. That 7% is going to be fully taxed as per yours, like as if you're earning salary and things like that. But that's guaranteed. It's not going anywhere. Once you've gotten that contract will be honored through and through. Question now is, do you have that big chunk of money? And is that 7% going to be sufficient for you for the next 10, 15, 20, 30 years of your life? Till the time, and they pay you till 100, basically. So a lot of products do that. Then you have another kind of product. From the same insurance company, there are ULIPs, okay? And ULIPs also sometimes have a life of 100. But now in ULIPs, the beauty of the ULIP is you are controlling that investment. So there is no guaranteed money that you're getting in, but it's a much better bet because what happens is, and why I quite like this category of product is, it's all set for you. So for example, if something were to happen to me, and if I'm not able to sign at some point in time in future, but I've got into that product, maybe in my 50s or 60s or even 40s for that matter, then that product's retirement benefits start kicking in from 55, 60. They give you that facility of withdrawing a certain percentage of money. Now you know that if I had and by the way, like I said, you can control the money, right? So you can say that I want 60% of my money in equities, 40% in bonds, right? Then you know that you're going to earn about 11 or 12% on this kind of a portfolio. So you tell the company that, every year, give me 9% of this money. What I mean is, let's put some numbers to it so people understand this better. So you accumulate a corpus of, say, crore. At that age of 60, you tell the company that 60% equity, 40% bonds. So your volatility is lesser, you've slowed down, your risk is much lesser. You will earn 12%. You tell so 12% means on a crore, you're going to earn 12 lakhs. But you're telling the company that, well, just pay me 9 lakhs or 9% out of that. Okay, so they'll pay you 75,000 rupees a month. Whatever is the tax, it's long-term capital gain and all that. But they'll pay you that 75, and they'll keep doing that through and through. You want to increase that? That's possible. You want to change your allocation? It's possible. But you don't have to do anything. If you just let it remain on autopilot, even that's cool. Now we come to the third area. So if you want to be a little more involved or connected to your investment, then you can do pretty much the same thing with a hybrid mutual fund. And the hybrid mutual fund category then also allows you to have about 2/3 of your money into equity and about 1/3 there. See, the beauty of it is, although it's equity, but the equity percentage is not 100, it's 65. There are products even with 30. So when the market goes down, that product will not lose as much. So you will not lose your health. You will not get more stress. That product is pretty well managed in terms of risk. And from that product, there's a beautiful facility called the systematic withdrawal plan. So if I were to invest, again, the same 1 crore into a hybrid fund, I know that I will earn about 11 or 12% on that. With the way the allocation is, I can initiate an SWP into that product, and I can tell the company that, you pay me 8% or give me a 9% withdrawal out of that. Okay. And you can mathematically do that. So 9% on a crore is 9 lakhs. Divide by 12 is 75,000. So like every month, please send me 75,000 in my account. In the year in which you have a good rally and you see that your crore has become 1 crore 30, despite you taking this money, maybe you have a blast and do a holiday. That year. And then the next year.
It's interesting how you talked about the year where the markets do really well. We are, of course, speaking at a time when the markets, there's a bloodbath in the markets world over.
Yeah.
So if, you end up retiring or slowing down at a time like this, and you need that money at that point in time, how does it work then? Does the money does the sum that you were supposed to get, would that reduce?
So these things will happen, and they'll keep happening at regular intervals. What happens is, the beauty is you're not going to use up all your money on that one day, right? You're going to use this money over the next 20 or 30 years. So what is your need today? If your need today is that 9%, say 75,000 rupees a month, just giving an example, if your need is that much, so what if your portfolio also went down from 1 crore to say 92 lakhs, for example? You're not going to use the entire 92 today, right? You're only using 75,000 from there. Okay. Now, at some point of time, things will turn around, things will recover. You've done your investment from, let's say, a 20-year point of view. There will be many instances today when you start and you're so unfortunate that you put in a crore and it's down by about 10%. That's okay. You continue your life, you live your 75. Maybe in the next 2 years, your pot will fill up again. And then the fund value would be 130 and you're still getting your 75. With the facility, like I said, you can even increase that a little bit. You can even withdraw some money. If you feel more jittery, you can take out that money and put it in a fixed deposit also.
We did speak about equity, but there is also something called a reverse mortgage, which is an option available in India. Is that something people should be exploring if they have more than one property?
So what happens is, psychologically, we still don't see. Maybe you and I may not be that emotional about the property that we have. But a lot of times, a lot of people in the generation above us, the people who are in their 70s and 80s, they are very emotionally connected with their properties. So they don't even like this idea of reverse mortgage. But yes, if we don't have anything else, reverse mortgage is like a godsend idea for us.
Could you explain it for our viewers?
It's a very simple concept. In one line, if I had to say, and I will elaborate, but in one line, it's the opposite of buying a house. So what is happening is here, when you were buying a house, you took a loan and then every month you were paying a little EMI to that. And brick by brick, you were building your house. I mean, psychologically speaking, because your house is something that you're already living in, but you're paying for it over the next 10, 15 years or so. Here, you are selling your house brick by brick. So what is happening is you do the same thing. You give the mortgage of your house to the bank. The bank will pay you a certain amount of money every month. They will, of course, value it if your property.
So the bank is paying you an EMI.
Yeah, the bank is giving you a cash flow. Or we don't call it an EMI, but we say it's giving you a cash flow. So now normally the property is say 1 crore. The bank would say that, okay, I will value this at for the mortgage purpose, I'll value it at say 60% of its value. So 60 lakhs is the loan I will give you, and I will give you this loan over a period of the next 10 years. So I will give you maybe 50,000 every month. So 60 lakhs divided by 10 years, let's say is 6 lakhs a year and 50,000 a month. I'm just making it very simple. But when you actually sit down with the banker, then they'll have their own schemes and methods of doing. But principally, they will be somewhere around this concept. So every month they are giving you a cash flow. Now what is happening is there is an interest which is getting accumulated behind somewhere, right? Because if the bank's going to give you money, it's not going to happen for free. You, however, don't have to worry about it because it's your second property. Or for some people, it could be their first property also, right? I mean, their house in which they're living, and kids are abroad or they're in another city. Kids don't want your property. So eventually, a lot of people will go down that road also, saying, let me take some loan out of this. When I go away from this world, at that time, my children could sit with the bank and decide what to do. So the bank will go ahead and auction that property off. They will recover from the proceeds of the property. They will pay themselves their loan. They will pay themselves all the accumulated interest. Whatever is left is paid to the children. Oh, and the children yet have another option. If the children want to have that house, then they will, take the mortgage on themselves and pay an EMI back to the bank. Or they could in one shot just pay the capital plus all the interest accumulated to the bank and they can have that house. So it's a very nice concept and worth exercising if you didn't have too many options. And I'm thinking that over a period of time, we'll see this market of reverse mortgage will develop quite beautifully and a lot of people will be taking advantage of this facility.
Yeah, of course. I mean, this has been around for some time. And like
Yes.
Karthik said, one of the reasons people don't really get into it is because of the emotional attachment. The other reason also, Karthik, and is that people are not very happy with the valuation that the bank, typically gives.
Typically, they will be in line with they're not happy with the loan to value ratio. So what happens, and it's not adequate. So think about it this way. Same example, your property is 1 crore and the bank will say that, look, I will only give you a facility for 60% of this money. Now, the person wants to have 9%, say 75,000 is his monthly expenditure. He needs to have a 9% payout from this property. But if the bank is going to give only 50 lakhs or 60 lakhs as a facility, and then when you divide that by, let's say, 60 months or something, the inflow is not going to be enough for them to take care of their requirement. A lot of times that is a problem. That is a roadblock.
And one other thing before we wind up, Karthik, and this is a problem that a lot of people face when either of the spouses pass away, which is, how do you access the money that they have saved, the money they have their deposits, or in their demat accounts, etc. So what are the 2 or 3 things that we should do in our lifetime to ensure that, we are not in a situation like that?
So the most simplest thing to do is pick up a little notebook or a diary at home and just write down everything that you have. And a lot of times it happens in our Indian society where the men, the husband, the father, the brother, the son, somebody's taking care of everything.
So
Pencil, paper, just write it down. It's so simple. There are facilities like CDSL, there are, facilities like CAS. But then your email needs to be perfect, your mobile number needs to be perfect, everything has to be synchronized. A lot of times investments are forgotten. That's why you have these government schemes which tell you put in a PAN number and try and find out all the forgotten investments that you have and all that. So it's just such a nice thing that just write it in a notebook or, you can of course write it in an Excel spreadsheet also, giving all sorts of details like login, password, etc. and put it on a pen drive, give it to your spouse. There are a number of ways of doing it. But I'm saying the simplest thing to do is to do that. And the other thing is, if you're managing the money alone and if your spouse, especially the lady, is not involved in that decision, that lady must know who's the chartered accountant, the lady must know who's the lawyer, the lady must know who's your financial planner and must have their numbers all the time. Then it's your responsibility to ensure that if something happens, even if I get ill in the hospital and I'm not in a position to respond or to talk to anybody, at least you know what to do. You know who to contact, you know how to go about, where is the locker, where is like the checkbook lying and things like that. So it's nice to have, shall we put under the broad label of conversations with your spouse about your assets. So very, very important. Spouse or whoever's your child, your son, your daughter, your brother, whoever, somebody that you can sort of depend upon in time of your very, very critical or a crisis situation.
Right. So essentially what Karthik is telling us here, and Karthik, I remember there's one other thing you told me once when we were chatting, which is you need to know your spouse's, lock in the pin code to unlock their phone.
Yes.
And you need to know their email passwords, because if all else fails, that is an easy way to be
it's a fail-safe method. So a lot of times, and like you said, we'll have this conversation at another time. But I think in today's time and age, it's extremely important that you never, ever lose your mobile number. You never change it and you don't change your email ID. And having said that, all your bank accounts, all your investments, especially the financial assets, your real estate also should have your mobile number and email registered with it for things of property tax and all that. But otherwise, for your financial assets, if your email and your mobile are working perfectly well, your spouse, your children, everybody can have access to it when the need arises. Otherwise it can just be with you. So I think you should guard your number. I mean, it's okay if you lose a phone, you'll get another SIM card and all of that with the same telephone number. But so important to make all these things electronic, so you're able to access. So even when you have a situation that you can't sign, but if you have it electronically, you can have somebody help you pay, or you can have somebody help you, buy things and do whatever you need to do on your day-to-day basis.
Well, that's two different kinds of advice you're getting right over there, but ensure that you do both. Go electronic as far as your transactions and records are concerned, but ensure your nominations are in place. But also, and very, very important, keep a notebook that has a record of all your investments. Go analog over there so that your family can access it even if you are not there. But speaking specifically about investing for a 100-year life, equity, like Karthik tells us, is the best bet to grow your wealth and to be able to pay yourself an income. So when you choose to slow down, reverse mortgage is another instrument that you can also explore. And of course, like we discussed in an earlier quad podcast, ensure that you build a second career as well. Now, you need to do all of this in your 40s so that when you do choose to slow down, your income doesn't have to. I hope this conversation got you thinking about preparing for the 100-year life. And of course, that is our goal here on the Longevity Shot. So don't forget to subscribe to the Never Too Late channel. This ensures that you stay in the loop for whenever we have such conversations, and we will have lots more of these. That's a promise. Thank you for watching.